Welcome to the Cherry Beckert Industrial and Consumer Goods podcast series. We aim to explore this dynamic world, discuss the operating challenges facing manufacturers, and offer new ideas and solutions. Join us as we uncover growth strategies and enhance after-tax cash flow in the ever-evolving industrial and consumer goods landscape.
Hello and welcome back to another installment of our Industrial Manufacturing and Consumer Goods podcast series. I'm your host, Corey York, a finance strategy and operations professional at Cherry Beckert, long-suffering Cleveland Browns fan and junk food appreciator. Joining me once again is my colleague, Mike Piotrowski, finance transformation leader with 2 decades of experience helping CFOs and private equity owners unlock working capital and modernizing their finance function. On this episode, we're flipping the script to focus on the other side of the balance sheet, accounts payable optimization. AP is much more than a routine task. It's a direct reflection of your company's financial discipline. When it's managed strategically, it can dramatically improve cash flow, strengthen supplier relationships, and unlock hidden value. But when it's not, it becomes a major source of friction and a drain on your profitability. We're going to dive into the challenges, reveal the hidden opportunities, and show you how to transform your AP function from a cost center into a strategic advantage. So, Mike, thanks for joining me again. We've recently covered accounts receivable, but for many businesses, accounts payable is the larger and more complex piece of their working capital puzzle. Why is it so important to get it right?
Well, thanks again for inviting me, Corey. And we've talked about accounts receivable as the heartbeat of cash coming in. If that's the case, then accounts payable is the gatekeeper. It's the guardian of cash that flows out of the business. While AR is about collecting what you're owed, AP is about controlling what you owe to others. It's simply the money you spend to keep the lights on and to keep the supply chain moving. When you don't manage AP effectively, you're not just paying bills, you're introducing risk to your business. A clunky, inefficient AP process can lead to missed opportunities for discounts, costly late fees and penalties, and even creditworthiness risk with key suppliers. This is a serious but often overlooked point. Suppliers often report payment history to credit bureaus, and a poor payment record can harm your company's credit rating. In the worst cases, it can trigger unfavorable clauses in contracts, increasing your costs, and even putting your supply chain at risk. Therefore, when you optimize AP, you're not just processing invoices, you are strategically managing your cash position and building stronger, more profitable partnerships.
What are the telltale signs that a company's accounts payable process needs a serious overhaul? What metrics or red flags do you look for?
The warning signs often surface in the same places as AR, in the numbers and in the day-to-day operations. The most telling financial indicator here is a high days payable outstanding, or DPO number. This metric tells you, as we've discussed in previous podcasts, how many days it takes your company to pay its suppliers. While a higher DPO can sometimes mean you're holding on to cash longer, an inconsistent or excessively high DPO can be a sign of a chaotic, inefficient process. Beyond the numbers, you're going to see operational warning signs like a growing stack of paper invoices that must be manually entered, finance staff spending countless hours chasing down approvals, repeated late payments even when you have sufficient cash on hand, a high volume of supplier disputes due to billing errors or lost invoices, and finally a lack of centralized visibility, meaning no one can easily see the status of an invoice or when payment is due.
So let's talk about solutions. What are the main levers a company can pull to improve their accounts payable performance, get a better handle on their cash flow?
You're right, Corey, it can feel overwhelming, but we found there are 4 levers that drive the most impact. Each one is a critical piece of the puzzle, and when they're all working together, the real magic happens. Firstly, it's about centralizing and streamlining your processes. This is the foundation. It's about having a clear, standardized workflow for every invoice, from the moment it's received to the moment it's paid. For example, a best-in-class company might have a single email inbox for all invoices and a clear automated routing system that sends the invoice to the right person for approval every time. Secondly, eliminating manual data entry, and this is all about getting it right from the very beginning. Manual data entry is slow, expensive, and a major source of errors and potentially fraud. We focus on implementing technologies like optical character recognition, or OCR, that can automatically scan, read, and populate invoice data into your system, reducing human error up to 99%. Thirdly, implementing smarter payment strategies. This is about working smarter and not harder. Instead of paying every invoice immediately, you can use dynamic payment scheduling to hold on to cash longer while you're still paying suppliers on time. And for your most valuable suppliers, you can take advantage of early payment discounts, which in some cases can amount to a significant return. And lastly, optimizing the use of technology, which again is a key enabler. The true power lies in automation. And as we mentioned previously, we help clients implement technology to handle these tedious, repetitive tasks. For example, OCR automatically scans and extracts key information from invoices, which cuts down on manual effort. Once an invoice is in the system, workflow automation automatically routes it to the right person for approval, and a feature called three-way matching can automatically compare the invoice, purchase order, and receiving report to ensure accuracy. This frees up the finance team to focus on strategic tasks instead of just pushing paper.
These strategies sound pretty comprehensive. I imagine some of our listeners do live with the fear of damaging the relationships with their suppliers by changing payment practices. How do you balance strategic accounts payable with keeping those partners happy?
It's a real legitimate concern, Corey, and it's not dissimilar to what we discussed during our AR podcast. This is why AP optimization isn't just a finance exercise, it's a supplier relationship issue. The key here is to shift the mindset from a confrontational us versus them approach, which we talked about during our AR podcast, to a more collaborative, let's solve this together approach. For your most valuable suppliers, you don't use the same automated one-size-fits-all approach you might use for everyone else. Instead, you take a soft, strategic approach. You have a conversation. This is where you might bring in a senior finance leader or even a supply chain manager who has a strong relationship with the supplier. The conversation should be empathetic. You can say something like, we value our partnership with you, and to ensure we can continue providing you with the highest level of service and the best products, we're implementing a new process for managing our accounts. We want to work with you to find a solution that fits both of our needs. This can lead to a more flexible but still firm payment plan, or even an early payment discount for those who pay on time. The goal is to set clear expectations and reinforce this isn't a punishment. It's a way to build a healthier, more sustainable partnership for the long run. A clear policy, if it's applied fairly, removes ambiguity and actually strengthens trust over time.
You're right. It's a strong echo of what we discussed during the accounts receivable episode. You're right. That's a strong echo of what we discussed during the previous accounts receivable episode when you stressed having these candid, empathetic conversations with the customers and then sort of applying that to vendors as well. Let's get specific, though. Could you walk us through a simple scenario to show us the true impact of this? Take a company with, for example, 600 million in COGS annually and maybe a current days payable outstanding of 45 days. How much cash is locked up there, and what happens if they can improve it?
Great question, Corey, and here's where the numbers really start to speak for themselves. Let's break it down. If a company has 600 million in annual COGS, that's roughly 1.64 million in spend per day. At a DPO of 45 days, they're holding about 73.9 million in accounts payable at any given time. That's the amount of cash they're effectively using to float their operations before paying suppliers. Now here's the opportunity. The first scenario is hitting the median benchmark. If they improve DPO from 45 days to 60 days, which is the median across many industries, they'd unlock an additional 15 days of float, which is approximately 24.6 million in newly available cash. This is not dilutive capital, no debt, no equity, just smarter operations. The second scenario is becoming a top performer. If they push DPO to 75 days, which is common among top quartile performers, they unlock 30 more days of float beyond their current state. That's $49.3 million in working capital. which is a game changer. It's enough to fund a major initiative to reduce debt or build strategic reserves.
50 million. That's a spicy meatball. You talked about benchmarks. Top performer, median, top quartile. Where do these benchmarks actually come from?
Good question, Corey. And again, these aren't arbitrary numbers. As we mentioned in our previous podcast, these numbers come from the aggregate financial performance data of thousands of companies compiled by organizations like the American Productivity and Quality Center, or APQC, and various credit and financial institutions. They give us a clear objective measure to compare companies' performance against its peers, and it's how we know whether a 45-day DPO is a red flag or just a reflection of how the industry sector operates. Most importantly, it helps us identify real, achievable targets for unlocking cash.
It's great stuff, Mike. That wraps up today's episode on accounts payable optimization, critical driver of cash flow and overall business health. Mike, thanks again for sharing your expertise with us today.
You're very welcome, Corey.
And thank you, listeners, for joining us. We look forward to having you with us for our next episode in the Working Capital Optimization series, where we'll discuss cash management.
Thank you for listening to our podcast today. For more information, visit our website at cbh.com/manufacturing, where you can give feedback and connect with our professionals. If you enjoyed this podcast, please subscribe, leave a review wherever you listen to your podcasts, and share with your colleagues.